Hello everybody, it is Michael here from My Retirement Trading, and I just got done completing my second interview with strategist from YieldMax, Mike Khouw, and it was an amazing interview, and I can't wait to share it with you. Hello everybody, it is Michael here from My Retirement Trading, and today we have a very special guest. But before I get into it, I must state that none of this is financial advice or a recommendation, and it is for entertainment purposes only. With that being said, let's welcome our special guest, Mike Khouw, strategist for YieldMax. Welcome to the channel.
Thank you very much for having me.
Well, Mike, in case anybody doesn't know anything about you, tell them about yourself.
Yeah, my background is in options trading. I started as a floor-based options trader on the Philadelphia Stock Exchange in the late 90s. Traded volatility. At that time, I moved to the American Stock Exchange after probably about 2 years, and then ultimately to the New York Mercantile Exchange, where I also traded options, but in that instance, it was on oil and natural gas futures. So it was options on those futures contracts. I've worked on the buy side and the sell side. So that was a sort of a market making and prop trading background, but I've also worked on the buy side for a large hedge fund and on the sell side for Cantor Fitzgerald. And I think it was back in 2008, I was approached by CNBC. They were interested in doing a show about options trading. And that show was ultimately created, started in January of 2009, called Options Action. So I've done, maybe 3,000 plus live TV shows on CNBC talking largely about options and investing. And then recently I joined as the YieldMax strategist. So that was probably in August or so of this year. And that was after I was doing a video, probably kind of like this one, talking about some of their products with another friend of mine, a good friend of mine, who was in the business with me. So he and I had worked together. He had founded a firm called Dash Financial, which is, it's kind of a behind the scenes options trading firm. What they do is they do all of the algorithms and pipes essentially for, institutional market participants. So it's not an offering for retail, but a lot of banks use their systems. And, I don't know what percentage of the daily options trading flow crosses those pipes nowadays, but it's probably high single digits at least. It may be in the double digits by this point. So when you see a lot of the trades that are hitting the tape, many of them are handled by Dash. And he and I were just having a conversation about YieldMax products because he's really into crypto as well. He's a big crypto investor, and a number of the YieldMax products were based on crypto. So we were having a conversation about it, and it turns out that Jay Pestrochelli and Scott Snyder, head of trading, and this, they're both sort of heads of trading of a different sort. Scott sort of oversees the day-to-day. They happen to be watching it, and they called me up and they said, you seem to understand options and these products. Maybe you'd be interested in joining us. So one thing led to another, and here I am.
Very impressive. So, Mike, talk about YMAG, if you would, and for the audience.
Sure. So, there's over 50 YieldMax funds at this point. And, some of them folks are probably pretty familiar with. We have single stock covered call funds. The single stock covered call funds are basically where we create a proxy for the stock because of the way ETF rules work. You can't actually buy the stock in those funds, and then you buy a synthetic, and then you sell covered calls against it. Now, there are people, of course, who are not interested in necessarily individually going out and picking those stocks for themselves. So we also have some sort of fund-of-fund products, and the fund-of-fund products can come in a couple different flavors, but one of those is that they can go out and buy our own single stock covered call funds. Now, the important thing to understand about these is that when you buy a YieldMax product that does that, it's not a, you only pay the fees once effectively, right? So there's a credit back. So it's not like, you're buying a YieldMax product that you have to pay fees on, and then, it in turn pays fees on other YieldMax products. It doesn't work like that. But basically what these things do is invest in some of the other YieldMax products. And that's what YMAG does. And as the name implies, that one invests in the Mag 7, right? So if you look at its constituents and you're looking at their weights, what it's going to have in it are the YieldMax covered call strategies in Meta, Tesla, Amazon, Microsoft, Apple, Nvidia, and Alphabet, also known as Google. And in this way, you essentially get exposure to, I think we can safely say, the biggest driver of equities over the course of the last couple of years, and also the covered call strategy. And that's what that does.
So can you pull up a little chart about the performance on it?
Sure. I'll do that right now. We can take a look. And I just want to make sure I'm getting the right screen here.
And just to be transparent, I do own YMAG.
Okay. Well, that has probably worked out okay for you then, because it has actually outperformed the S&P so far this year. And hopefully you're going to see my screen right about now. So this is YMAG year to date. And just so everybody's familiar, I think it's really important when you have these high distribution products, it's really important that you look not just at the price chart for the underlying, but also what the distribution adjusted or dividend adjusted price would be, and then also all of the respective dividends. There's a couple of ways to think about this. Is you want to take a look at the price change of the underlying security, the amount that you've received in distributions and when you receive them, and what you may have done with those. So let's just take a look at that right now. And as we're looking at this, in orange, this is essentially the dividend adjusted price for YMAG since December 31st of last year. So this is essentially the year-to-date performance. We're almost to the end of the year now. And this just assumes that you had taken your distributions and reinvested in the equity. And if you're looking at that performance for the year, this screen, for those who aren't familiar, this is just my Bloomberg terminal. So the total returns for YMAG year to date, if you had reinvested the dividends, is just under 18.2%. And actually, we can compare that, for example, to the S&P over the same period. This one I will also adjust for dividends. So, yeah. So had you reinvested your dividends there, and it's been a great year for the S&P. The S&P's had a number of great years, but 17.7. So you're looking at outperformance net of fees. Now, had you simply taken the distributions and say you were going to live off of them and just put them into your money market account, then you would have gotten a number like that. So just under 13%. And the blue boxes indicate where you would have been getting your distributions, because this one pays out distributions weekly.
So can you talk about CHPY as well?
Sure. Actually, I stopped sharing, but maybe I'll go back to sharing. And we can go through a few of these and take a look at them that way. So CHPY, and we can do this. I think it's helpful to do two things. One, we can take a look at the returns, which are here, and the other is we can take a look at the constituents. So in CHPY's case, it's a little bit different than YMAG in the sense that when you're looking at YMAG, it is buying the single stock covered call ETFs that YieldMax offers, whereas CHPY, and this is also true for BIGY, for example, some of those, this one actually is constructing the portfolio of the underlying stocks and then writing call options against it. So you can see here what those holdings are. Unsurprisingly, as the name implies, you're dealing with a lot of semiconductors. That's why it's called CHPY. Or in the case of something like ASML, so what does ASML do? This is a Dutch company well known because they actually create the technology that makes making these ever better chips with the really, really fine, where you're dealing with, when you're dealing with construction of these chips that is measured in single nanometers. ASML is the company that actually creates that technology. But that's essentially, these are the stocks that are in there. You've got 20 chip companies. All of the big names are in here. And this one sells covered calls on those stocks. And if you're taking a look at the performance of this one since the beginning of the year, again, had you reinvested the dividends back into the fund, you would get this orange line right here. Year-to-date, it's year-to-date performance. It's not going back as far as YMAG did, because this one actually was launched this year in early April. So I can't go all the way back to the beginning of the year. But the performance since April has been pretty good. By that was a reasonably fortuitous time to launch in some ways for almost any equity product, because we had that post-Liberation Day sell-off, and the tariff tantrum, whatever you want to call it. So that was kind of marked the lows of the year, was in early April. But the performance obviously very good. If you had reinvested the dividends, just under 65% year to date, which I think most folks would say is very strong. Had you just simply taken the distributions in cash, the returns are 58% year to date, as you can see here. And of that 58%, 31% are coming from the distributions, or 30%-ish, plus the interest you would have earned on those. And the other 27% are coming from the returns on the stock price. So some of that was distributions, about 30%, and some of that was returns in these stocks. I don't think I need to tell anybody that chip stocks have done really well this year, because they have.
Yeah. Is this YieldMax's best performing fund this year?
I believe it is. Yeah, I mean, let's actually take a look. I mean, I'm a little reluctant. I mean, it could be. I would imagine that NVIDIA has probably done pretty well. Yeah, it has. It's up over 60%. I don't really like comparing the single stock funds to the diversified funds, right? Because the diversified funds are both buying the stocks and doing the option strategy, whereas the single stock covered call ETFs, the investors get to decide whether they want to own that stock or not. Because in many cases, you're dealing with situations where we have both a bullish strategy and a bearish one. So, for example, on Strategy, formerly known MicroStrategy, we have a bullish. That was one of the best performing funds last year. It was up over 100%. But we also have a bearish one, which was not one of the best performing ones last year, because obviously Strategy did very well. Winter, I'm assuming, certainly since the sell-off, so if we look at the highs of Strategy this year, so Winter has done 78% return since Strategy peaked on July 16th. But this is just the vagaries of how single stocks perform, right? So I think it's probably best to look at the diversified funds as a better sort of gauge of how some of these things are performing. But yeah, on the diversified fund side, yes, CHPY has certainly. I think SOXY has also done very well. Let's take a look at that one, where that one is as of today. So we'll go back to the beginning of the year. Not as well, but it's up almost 40%, and for similar reasons, right? It has many of the same stocks in it, and it's some of the better performing ones this year. And certainly since this Liberation Day low, that was back on the 8th of April. Yeah, I mean, off of that, it's done pretty exceptionally. But yeah, I think CHPY is the best performing one year to date of the. And again, is it even a diversified fund? It is diversified in the sense that it has 20 stocks in it, but it's sector exposure, right? You're exposed to semiconductors. So it's a big part of the exceptional performance that we've enjoyed in that fund in particular is a byproduct of how the sector's done, and the sector's done very well.
So I heard you mention BIGY. Can you talk about that one a little bit?
Yeah, BIGY is, it's interesting to me. This is personally, it's one of my favorite products within the YieldMax lineup. And oops, let's see here. This is not the right stock. So that's a Canadian stock, which shares the same ticker. There we are. So what this is basically investing in the top 50 largest companies in the US and then selling covered calls on those. And here too, you're going to notice that it has outperformed the S&P on a total return basis year to date while paying, very good monthly dividends. So if you're, anybody's wondering, you're looking at what are the top 50 largest stocks, you probably know what these are anyway, but I'll bring it up on the screen anyway so that everyone can have it. Obviously, it's got the Mag 7 in there. And as we scroll down, you're going to see names like Netflix and some industrials like Caterpillar, a number of financials. We've got Morgan Stanley, McDonald's, Intuitive Surgical, and so on. So this is the 50 largest companies. And then, again, it's just a covered call fund. So you're selling covered calls against it to generate some premium. And then those premiums are distributed monthly so that people can have some distributions to live on, or potentially, I guess, to reinvest. But I think a lot of people are using these things so that they can live off these dividends. We actually just had the 1 year anniversary for this one. So this one is just over a year old now. But I think this is an interesting and well-diversified fund. And what's interesting about this, too, is that it behaves a lot like the S&P does. So I'm a little bit surprised sometimes that this one hasn't attracted more assets, because if you look at it, so I'm going to have to make, as I put this up on the screen, just so everybody knows what I'm doing, I have to adjust these prices so that we're getting the total returns for each of these, and we can compare them to one another, net of dividends, because you obviously have to include your dividends. So we're going to put the total returns, gross of dividends for that in there, and then we need to do the same for the S&P. And then I have to normalize it so that we can compare essentially like for like. So we'll put the beginning of the year in, and now. So you can see here that these two behave very much like one another. And this is what you would expect, right? So if you buy the top 50 stocks in the S&P and sell covered calls against them, you would expect it to behave a lot like the S&P itself. I mean, consider this. 41% of the S&P 500 is just the top 10 stocks. So the top 50 is, most of the index. So you would expect the top 50 to behave a lot like that. But you can see here that, it's done quite well and has outperformed. So this is the relative performance of the two down here on the bottom. And you can see since mid-May, this thing has, outperformed by about 300 basis points, which I think is, I realize in this day and age, people they're so used to the markets returning 15 to 20% a year that when somebody says, oh, one fund outperformed the market by 300 basis points in 6 months, that just doesn't seem very exciting. But it's non-trivial. It's not an easy thing to do. So, I'm pretty pleased with how that one has managed to perform.
So that's one of your Target 12 products?
This is a Target 12. That's exactly right. So the Target 12 products are looking to make distributions of about 1% per month, and we have a couple of those. But this is the one that's basically take the U.S. stock market and try to create a 1% per month distribution off of that.
And have you all been pretty close with that?
With the 1%, yeah.
Yes.
I mean, if you take a look at the total returns, so you can look at it this way. So the difference right here, this is the distributions that have taken place. And as you can see, so we've got 14.47% total returns, 2.6% coming from the price change in the underlying. So you can say 14.5% less 2.5% is 12. So it basically
Very cool.
hit it right on the number.
So when I was looking on your website, I seen another product that a Target 25.
Yeah.
Can you talk about those?
Yeah. So the Target 25s, it's basically the same idea. The thing about the Target 25s, of course, is that the Target 25s, one of the issues that you have. So what are the drivers of returns? The things that are drivers of returns are going to be the performance of the underlying assets, of course, because you're buying stocks, and then also how expensive the options are against the stocks that you hold. So in the case of the Target 25s, what you're looking for is essentially a similar objective set to what you have for the Target 12s, but looking for, as the name implies, a 25% yield over the course of a year. So a rate of distributions, we'll call it, of give or take about 2% a month is the objective.
So when you were on the channel last time, we talked about ULTY, and there's been some changes to ULTY lately, right?
Yeah, there have been a number of changes going on to ULTY, and while am I still sharing my screen? If I am,
yes.
Okay. So let's take a look at some of the things that are going on there. One of the things that I think we've heard from investors was that they would like to see, if possible, more NAV stability. Now, an important thing about that, as I've previously described, when it comes to distributions, in order to preserve the fund's pass-through status. And what is the pass-through status? That basically means that the fund itself does not get subjected to tax. So there's no double taxation. So you don't want the fund to experience some sort of corporate income tax. To do that, you have to pass through 90% of the realized gains, importantly, the realized gains, income, dividends, and interest that the fund receives to investors, and then leave it to investors to determine whether or not they want to take some of those distributions and then reinvest through, call it like a dividend reinvestment plan would be one way to do that. Now, one way to introduce sort of more NAV stability is to have an underpinning pool of assets that you can hang on to for a relatively long time, number one, and not realize gains. That would be one way to do it. It's one of the reasons why you can have some funds that, they don't pay big distributions. They just never sell the assets. S&P 500 funds, typically, they have some pieces coming in and some pieces coming out. But because those are such small pieces, they're almost unobservable. They're so small. They're kind of de minimis because, as I pointed out, most of the big indices that are very passive, it's just those top stocks, and because it's cap weighted, they don't fall out until they are much smaller. So, and by that time, their impact is going to be de minimis anyway. So, if you look at what's on my screen right now, one of the things you're going to observe is that there's maybe a slightly more diversified group of stocks in here in some ways when it comes to what we call pairwise correlations. So what I'm going to do is I happen to have, and I think this is kind of interesting, and it's actually something that I think is important to understand about the performance. This is something called a correlation matrix. So if we take a look at how the stocks inside of ULTY behaved, and I think you and I spoke, the last time we spoke was in early mid-October, is that right?
Yep.
Yeah. So if we take a look at how the constituents of ULTY behaved relative to one another in the 5 weeks before we spoke last time, this is the stocks that were in there on October 9th. That's the reason why I have this date right in here, October 9th. And what you're going to notice is that there are some stocks in here that had a lot of exposure to crypto, I think it would be safe to say. So, for example, Coinbase, that obviously would. MicroStrategy clearly would. I think we had here it is, Bitmine Immersion we had in there. So they had exposure to the crypto trade, but when Bitcoin really rolled over, starting in that second week of October, one of the things that happened was that the constituent stocks inside of ULTY, their pairwise correlations suddenly shot up. So as you look at this screen, now it looks like the matrix, right? And the reason it looks like the matrix is because it is a matrix. It's something called a correlation matrix. Don't worry too much about the individual numbers. It's not important as I show this to people that they sit here and say, oh, okay, well, if I look at HIMS and I look at HIMS versus SMR, which is New Scale, that was a 0.181. That's not the important thing, because fortunately this is color coded. And the important thing to understand here is that when you see a white number, that means things are highly correlated with each other. And when you see a dark brown number, that means they're not correlated. And in some cases, you might find situations where they're anti-correlated, right? So Rocket versus Rocket Lab here, you can see that actually over the previous 5 weeks, one went up, the other went down. So benefits of diversification. Does that make sense? So now let's just advance the clock by 5 weeks. So we'll go to, say, mid-November in these same stocks. Again, don't pay attention to the numbers, just pay attention to the colors. And you'll notice here, by the way, before I switch it, that all of these white numbers right along the diagonal, that's because those stocks are just the pairwise correlations with each other. So this is FIG with FIG, see? And, so all of those are just, of course, stocks are perfectly correlated with themselves. Makes sense. Well, let's take a look at how the world changed when Bitcoin rolled over. And this is what happened. Now we see a lot of white. You notice that? So names that you wouldn't normally think, okay, this has a whole lot to do with, so you have, for example, the pairwise correlation between Robinhood and Coinbase went to almost 0.88, right? Those are not companies that, they weren't crypto trades per se. Coinbase is, but not Robinhood. Robinhood is a brokerage platform. There's only some crypto trading that's available on it. Those types of things ended up having a really big impact on fund performance, right? Palantir, for example, Palantir and Robinhood, the correlation went to 0.78. Well, Palantir is a technology defense business, which is very different than a self-directed brokerage platform. But that's a risk that happens to portfolios when you have this experience where you have something called conditional correlation, which is that all of a sudden constituent stocks start behaving a lot like each other, even though they don't necessarily have a whole lot to do with one another. Small modular reactors, for example, like NewScale is going to be producing, don't have a whole lot to do with HIMS and HERS. What does HIMS and HERS do? They sell generic pharmaceuticals, GLP-1s, things like that. So weight loss drugs, hair loss drugs, things like that. That kind of stuff. And excuse me, I should have muted that, and I will do that now. That has now been muted. Okay. And that's one of the things that happened in the ULTY portfolio. So if you look at the ULTY portfolio now, you're going to see, I mean, there's a lot of well-known names in here, as you would expect. Names that have suitable options premium, companies that we like. So there certainly is that. But you're also going to observe that there are things that really shouldn't exhibit high degrees of correlation. For example, there's some gold in here. Gold, Alcoa is in here. We've got Southern Copper. Some of the original names still exist. We still have New Scale Power, for example. But, the objective that Mike Venuto had was to ensure that at least 30% of the portfolio is going to be in what we call non-correlated names. Now, I want to be clear, non-correlated is not the same thing as anti-correlated. Anti-correlated means if one stock goes up, an anti-correlated stock would go down. They move in opposite directions. Functionally, they move in different directions. Non-correlated means that, number one, they don't have anything to do with each other, and number two, they just don't, there's no exhibited pattern where they do it. That doesn't mean that both stocks can't go up on the same day or down on the same day. That is possible. But in general, the objective is to keep a carve out so that there is, more of a non-correlated portion. Now, one of the things about having a non-correlated portion is that sometimes some of those stocks aren't going to have quite the same level of implied volatility, that is the price of options, that some of those other names we had. So a lot of the stocks that were in ULTY in the end of September of this year and early October were high beta stocks. And that makes good sense. I mean, the mandate of the portfolio managers was go out and find stocks that have high levels of implied volatility because we like to sell options on those. And those stocks also had been doing quite well. So there was certainly a rationale, but one of the nuances that's been introduced is to say, we don't want to see those kinds of conditional correlation risks reemerge. The way I like to describe it, you're always squeezing a balloon a little bit when it comes to investing, that you're trying to find a balance and you're going to make some trade-offs. And so one of the trade-offs that's being made here is to try to have at least a sleeve of the portfolio that is non-correlated. And that's one of the things that people are going to see.
So, can you talk about your personal opinion on Bitcoin, and are you bullish on it?
Yeah, so this is an interesting situation. It's obviously been a rough road for Bitcoin recently.
Can you stop that screen share?
Yeah, I'm not going to, what I'd like to do actually is I want to give some context to what's happened in Bitcoin recently. So, why do I believe in Bitcoin? I believe in the underpinning technology. I think that's important. One of the other things I also believe is that governments have a hard time controlling themselves. And there's just a tendency for them to exhibit fiscal profligacy. Fiscal profligacy is generally going to be inflationary. And there's a couple of reasons, and some of them are intersecting reasons why that's going to be true. But the value of a dollar has lost essentially 99% of its value since we went off the gold standard. I think one of the reasons we've seen gold appreciate so much is, an appreciation that, hey, wait a minute, we have these massive deficits, massive debts. And at a certain point, the budget is not tenable if rates are allowed to just continue to float and potentially go higher. And what that means is that I think there's a sense that there's probably going to be some functional cap that takes place on how high rates can go. And if that's true, if they don't completely float on their own, then that suggests that monetary policy might become too easy, that real rates aren't going to be meaningful. Remember, we went to zero interest rate policy and real rates were flat to negative. And what ends up happening then is that the currency devalues, the dollar is debased, other currencies also are debased, and people want assets that they think are going to exhibit more stability. And I think Bitcoin has that. It has other benefits, as I pointed out, the blockchain does. But the context I wanted to provide here is this is a log chart. What I'm showing right now is a log chart of Bitcoin prices going back for 15 years. So that means that the percentage changes here are represented to scale. Because if I just did it as a as a normal price chart, it would look like a hockey stick. But this is so that we can see what the percentage changes are relative to each other. So if we look at that drawdown, for example, back here in 2014, Bitcoin fell almost 86%. If we look at this one back here, it fell 81%. If we look at this one over here, we can see that it fell 84%. And if we look at this one over here, we can see that it fell by 76%. And so big moves in Bitcoin, in crypto generally, but in Bitcoin specifically, are not uncommon in its history. We can see that there have been multiple occasions where it fell quite precipitously. And then when you look at the one that we've just suffered here, so this is from November to present, 33% or whatever. It does not seem quite as pronounced relative to some of those earlier historic drawdowns that we've seen in it. Now, I think the trend in general is that in real terms, the fiat currencies are debased, and anything that's seen as a, we'll call it a real asset or something that has some stability in its value in real terms is going to therefore appreciate relative to the dollar over time. And I think Bitcoin qualifies as such an asset. Could it pull back further than it has? It could. We can see what kinds of drawdowns we've had. Do I think it's going to experience a drawdown this big? I actually do not. But I just want to give people some perspective. A lot of people have commented that they thought, well, maybe it could get down to as low as, the mid 70s. And so the chart that you're looking at right here, this lower red line is, the lower Fibonacci retracement. I'm not a huge technical analyst, but I realize people pay attention to these things. So if people care, then I should also care. So as it happens, this price also happens to coincide with the cost basis that MicroStrategy has. And they're one of the largest holders. They have over 3% of outstanding Bitcoin. They have 651,000 of them. So it's an important level because it's a Fibonacci retracement. It's an important level because it's the cost basis that one of its largest holders has. It's an important level because the cost of mining Bitcoin varies from place to place. It's the cost of energy. In a high temperature place, you also have to cool the machines that are mining it. If you go to the places that have no real cooling expense right now and the lowest cost of energy, some suggest that we're getting down to we're now starting to approach the lowest cash cost for mining Bitcoin. So what's the cash cost? That means you're not accounting for the machines themselves, just the operating expense of the power required to mine. So I think that, for a host of reasons, there's, some critical levels that are at play here, and people should bear that in mind. But, my longer term view is that, Bitcoin has an important role to play. I would actually add, we can see that in gold and silver, that trade remains intact just generally. I would actually say, and I wrote an article about this recently, I think maybe copper, also. Because if you take a look at the gold to copper ratio, which has been declining, it's at basically record lows right now. Copper is an important industrial metal. It was actually a monetary, like a hard money as well. We used it to make pennies until the dollar became so devalued that the copper used in a penny was worth more than the penny. So we don't make them out of copper anymore. Just like we don't make gold coins and we don't make silver coins anymore because the currency has been devalued so much. But I actually think that copper could potentially do well. And so I'm happy to see that Southern Copper is one of the constituents in ULTY right now.
So, are you bullish long term in Bitcoin?
Yeah.
Coin? I mean, like,
Yeah.
And
Yes, I am.
so
I have been for a couple of years. Like, and on, I'll stop sharing my screen. I can always go back to doing it. But on CNBC, at the beginning of every year, we talk about our best ideas, and actually, also I have on my YouTube channel, on the Open Interest YouTube channel, I at the beginning of the year, I usually talk. So I'm going to be doing it again soon. My top ideas for the year. Last year, I included Bitcoin and one of the gold miners in it. And this year, Bitcoin was still amongst my best ideas, and gold as well. Bitcoin hasn't done so well, but overall, the names that I came up with have held in there pretty well, and that's because the thesis hasn't changed. It takes a big secular shift to move away from trade ideas like that one, and we're not there, because those sort of problems that need to be resolved haven't been yet. I don't know how we solve them, because we've been facing them for so long, and there just doesn't seem to be a political will to correct them. And for as long as that's true, the government is one of the biggest operators in the economy and to the value of currencies and the value of assets. We can't ignore it. And if the government doesn't change its behavior, we can't expect the general trend to reverse itself. Right? How could we?
So, one final question, based on basically the Bitcoin. What do you think of strategy long term?
So, like I said, I think there are some folks that are. I mean, it feels like some folks are shooting against Michael Saylor and against strategy. Jim Chanos is clearly. His pairs trade was to be short strategy and long Bitcoin. The logic of that trade was that he believed that the value of strategy should converge to, the value of the underpinning Bitcoin that they hold. Now, you and I did a little bit of math on this. They have 651,000 Bitcoin right now. Bitcoin is, in round numbers, it's about $90,000 per Bitcoin. So that works out to 58,600,000,000 in value for the Bitcoin that they have on their balance sheet right now. If we look at Strategy's market capitalization, which is, by the way, we have to start with the market capitalization, but we can't end there. The market capitalization is 52.3 billion. So, we'll just use round numbers just to keep it easy. So 58.5 billion of Bitcoin and 52.5 of market cap leaves 6. And the company also has about $15 billion of debt. And this is convertible. So they have the debt. I'm combining the preferred stock and the debt. And so some people are saying, well, strategy can and should fall to the point that the enterprise value, which is the market capitalization plus the preferred plus the debt, adds up to how much Bitcoin they have, the 58.5 billion. Now, if that were true, that would mean that it has to lose another $9 billion. And of course, that's not going to come from the debt side. That's going to come from the equity side. So that's, call it 17% worth of downside. That is not accurate in my view, though, because those debt instruments aren't necessarily convertible at spot. So, for example, they have zero interest, zero coupon debt that is convertible at strategy strike prices that are way, way higher than where strategy is now. So what does that mean? It means if Bitcoin appreciates, that the equity holders actually are entitled to the first sort of bit of gains in Bitcoin before the convertible debt holders are entitled, because they have to convert at strikes, in some cases, over $600 per share. So I don't think it's appropriate to compare the value of the Bitcoin that's on their balance sheet to the enterprise value. You actually need to think about it this way, and that is to say, okay, if you buy the stock here you are getting some measure of that is the underpinning Bitcoin, and some measure of that are essentially call spreads on Bitcoin, financed by the debt on the balance sheet. So what is the appropriate ratio, and could it go down? It could go down, and I think one of the reasons that it would is if they do, as some people have suggested, if they get pulled out of some of the passive indices, for example, that just creates some natural sell pressure, because holders of the shares that hold it in a passive fund would otherwise have to sell it. It's not a discretionary determination that they're making, but it's a real sell event that we should account for. But I don't think it's going to trade at a huge discount relative to the value of the Bitcoin that they hold, because it's a functional arbitrage, and people like Chanos are going to take the trade-off at that point. He's not making any bet other than the relationship between these two assets, and it's getting very, very close. We're getting close to 1-to-1 at this point. So if you are bullish on Bitcoin, then similarly, you should probably be bullish on Strategy.
Well, I would like to thank you for coming on to the channel again. And you shared a lot of great information today. And would you like to add anything on closing?
Well, first of all, thank you as always for having me. I really enjoy these kinds of conversations, and I think they're important ones. Look, in particular, I think this, the business with Bitcoin and Strategy is interesting to investors, and the thing to pay attention to in those trades really is pay attention to what governments do, to what central banks do, because at the end of the day, those are the things that matter most. There's an old saw: you can't fight the Fed. The Fed is one part of it. Our central bank, other central banks are another part. But I think you also can't fight, governments and their fiscal responsibilities or irresponsibilities, however you want to frame it. These are big players in economies, and they have a big impact on the value of financial assets. And they probably have the biggest, in many respects, impact. So if we pay attention to those, I think sometimes some of the trades we're in are kind of dictated by what they decide they're going to do. I see that here. And yeah, I mean, other than that, I'm reasonably optimistic, because we are seeing fairly good economic growth. I think inflation seems to be getting kind of under control. I think it's still a little bit higher than the headline figures, but a lot of companies' earnings that have come out, and actually consumer earnings. We're coming into the holiday season, so I think this is kind of an interesting thing. I've seen a lot of retail names that have been doing a lot better than people expected, and so I don't want to make it seem like it's all bad news because governments can't get their house in order. It does seem like some consumers have, or at least that seems to be the message that's coming from some retailers. So there's a little bit of good news going into the end of the year, I guess.
Well, like I said, I'd like to thank you again for coming on to the channel. And everybody, until next time, I will catch you all later.